Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Small caps are having a great run. He tells us what's happening with gold, silver, and the U.S. and Canadian dollars. Publisher of the realestatetiming.com newsletter, Robert Campbell, reports from San Diego on the U.S. economy, real estate trends, precious metals, and what's more important, money or health. WolfStreet.com publisher Wolf Richter weighs in on the U.S. credit card picture. He says credit cards are losing their popularity, and that has the central bankers concerned. He also comments on why farmers are upset about a shortage of shipping containers. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to the show, Ross, and Merry Christmas.
And the same to you and all the listeners out there. And we got 1 week to count down here, and then hopefully 2021 is a better year for everyone.
Yeah, and hopefully everybody got a pile of presents from Santa.
Yeah, well, hopefully the UPS managed to get it to them.
Well, you might have the 12 days of Christmas like Henry VIII used to have, where New Year's was the culmination of it all.
Yeah, we're waiting for some items to come from Black Friday, actually.
Yes, I know my solar tiki lamps took something like 6 months to get here from China. So patience is a virtue this time of year.
It's on a slow boat.
Ross, did we see a big Santa Claus rally? And if we did, does that tell us something?
Well, the Santa Claus rally, typically, we for over 20 years, have been taking the period here from the middle of December out to the first week of January as the seasonal trade. And we did our homework years and years ago on this one. The shame of it is that this year we've not had the type of pullback that really presents an attractive buying opportunity. The best trades have historically come when you've had a bit of a sell-off between the 10th of December and the 24th. And all we had was a little bit of thrashing around here in this last 14 days. Not enough to really kick in a good buy signal. So, typically the best, most reliable streak is the last 5 business days of the year into the first 2 January. And the bias is still up here, but we're starting to see things languishing. The advanced decline ratio, when we look at that over on the S&P 500 stocks, not doing as well as you would expect in a strong uptrend. And most of the indices are starting to languish. The Russell 2000, the small cap index, has continued to be the leader in here as of the end of the week, down on the last day of the week, but new record highs during the early part. So this index, and we talked about this a week ago, and I'm going to mention it again because it's so important. Over the last 50 years, back to 1970, we look at in time intervals where the small cap index, the Russell, has increased by more than 85% off a low. and has then generated a weekly sequential sell signal. That's when we get 9 weeks with closes above 4 weeks earlier. You've got to have consecutive ones. As of the end of this week, we've got 8 out of a potential 9 as far as that count is concerned. So going into the last week of the year, unless the market just absolutely gets hammered next week, we'll have a sequential 9 in place. And the third part of the equation that we'll be watching is that when the MACD, that's the moving average convergence divergence, just basically it's the difference between two moving averages. When we get a sell signal on that on the weekly chart, that becomes a catalyst for a sizable drop as far as the Russell is concerned. So in that 50-year window, there have been 10 of these examples, and the very, very reliable when we look back on them. So looking probably as we get into January that we'll get some type of a sell signal on the Russell. That will then have implications across probably everything.
What's going on with the Canadian dollar?
Well, a week ago, the dollar started to have difficulty holding up with the action that we were seeing over in the commodity sector. You know, you had crude oil up testing the $49 level. It's held in very, very well this week. You had the agricultural side, the DBA, which is the Deutsche Bank Agricultural Index. That closed off the week at its best level since back in January. So this thing, you know, it bottomed out in April through July, down at 13 and a quarter on the index. It's trading over 1580 as we closed off the week. So pretty big move. It's now pushed up through a lot of moving averages. The next resistance is probably up around 1720. And you know, with Canada historically being a commodity-based currency, it's disappointing to see such negative action here. The dollar down about 0.75 cents from a week ago, up a little bit in the last couple of days, but overall having a tough time maintaining that good uptrend that it had been in since the March low. So, you know, I think you got to be pretty cautious here as far as the Canadian is concerned.
The U.S. dollar, what's it doing?
Some nice capitulation lows the previous 2 weeks on the dollar index on the weekly chart, and haven't seen anything like that since back in January of 2018. So the possibility here of a decent rally. Index is currently at 90 and a quarter, let's call it. Good resistance, probably up around the 91 and 3/4 level. So wouldn't be at all surprised to see a bounce in here on the dollar index. And once again, that would have a negative implication for Canada. And that, if we were to get the bounce on the dollar index, probably keeps a bit of a lid on the precious metals. And early this week, silver got up to what we had as a targeted resistance. We've been looking for the rally off the low that we had in the early part of December. That wasn't so much timing model in terms, but from a pricing perspective, we hit a lot of key levels right in there at the first of the month. And the rally as of Monday had retraced 62%, that Fibonacci retracement level, of the decline from the August high. And that and the Keltner channel that we've been looking at had targets in the 2590 to 2690 bracket. So those have, the 50% was at 2590, the 618 was at 2690, and the Keltner was just a shade above that. So we've achieved good resistance, and right now, because we should be going into a seasonally strong period for these precious metals, we want to make sure they don't give up too much. So For silver, which is at $25.94 as of the end of the week, it really needs to hold at $24 even. Any strength in the dollar index that causes a pause in the precious metals, you're going to need to hold that $24 level for silver, or a much deeper break. And as far as the gold is concerned, it's been sort of languishing relative to the silver market, and really would need to gain a little bit of upside momentum at this point to spark the trade. So if we do see the gold break out through this immediate resistance, think about the run taking you into the latter part of January. But once again, I think like silver, you want to make sure that it doesn't give up too much on any short-term correction.
Ross, all the best, and thank you so much for your hard work.
Well, we enjoy being with you each week, and look forward to finishing off the year next week.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Robert Campbell, publisher of the realestatetiming.com newsletter. He's speaking to us from San Diego. Welcome back to This Week in Money, and best of the season.
Thank you very much, Jim. Merry Christmas.
First of all, can you just tell us a bit about the Campbell Real Estate Timing Letter and how people can subscribe?
Okay, what I do with my timing letter is I wrote a book called Timing the Real Estate Market in 2002, almost 19 years ago. And I presented a formula that I use, a real estate timing model, where I could use 5 key indicators for forecasting real estate prices. And historically, it's been between 80 and 90% accurate as far as getting the answer right. And I've used that model in the last for the last 19 straight years, and that's the main part of my timing letter. I'm 90% data-based, and the other 10% is based on, I do use some instinct and experience because I'm 73 years old and was born on a building site with a skill saw in my hand. My dad was a builder for 55 years, so I know in Southern California, so I know the cycles. And sometimes you just have to understand history, especially have to understand history, because most people's memory goes back 5 or 10 years. But, mine goes back, 60 years, because being in the building family, I remember the cycles, the ups and downs. When things are good, it's the best business in the world to be in. When things aren't good, it's the worst business to be in. So it's very, very volatile. You have to manage risk very carefully, which my dad did, and it taught me a lot. And that's why I'm able to help my subscribers and followers make the best real estate decisions for buying and selling.
Is the second wave of the COVID-19 narrative causing significant destruction to the economies of some cities and states and not others?
In some states, yeah, I think states here on the West Coast, like California, Oregon, the coastal states, that's for sure. Washington, Seattle, Tacoma, those kind of areas. Over on the East Coast, I know that, New York City is having a really, tough time. People are fleeing those areas like crazy because the economy's so bad. And they're shutting down, they're keeping everything shut down. And so they're leaving.
What's this economic destruction in some places and not others likely to do to real estate?
Well, it's the whole thing about real estate is you want to figure out where people are moving to and buy real estate there. There's an exodus out of the cities, as everybody knows right now, because of this ability to work anywhere, and to see, what legs this has going forward, time will only tell. However, right now, people are leaving the cities, and especially, cities like New York City and San Francisco City. I mean, rents on a year-over-year basis are down almost 25%. Rents in San Francisco are super expensive, as they are in New York. And so, not only is the economy going down because that rents are so high, and people can hire people to live in a place that costs half as much money and work from home, and so that's going to affect real estate prices and the economy, very dramatically.
Is that the trend? People are selling in the big cities and moving to the burbs and rural areas?
Well, yes, I would say that generally that's the case. That's what they're doing. That they're trying to get away from it. Now I think this is going to be a temporary thing. I don't think there's anything that this has any long-term legs to it, Jim. But that's what they're doing right now. And like for example, let me tell you about California, where I live, San Francisco, the Bay Area, San Mateo, Silicon Valley. The vacancy rate on 1 and 2 bedroom apartments is 25% year over year. And where are people moving to? They're not moving that far away. They're moving to Central California. If you go to places like Bakersfield and Fresno and Sacramento, rents are up double-digit year over year. So they're not moving that far away where they can't get back to their family and everything. They're just moving far enough away where they can cut their rents, in half or more, and still do their jobs and make, only take a 10% pay cut for not having to work in the office. And these businesses, here's where I think the biggest change is going to come. I think these businesses that rent this expensive office space are going to find out, we don't need to rent expensive office space. That, we can work virtually, our people can work virtually, and maybe we only need 50% of the office space that we normally needed. And that'd be a significant cost-cutting, enable you to cut costs significantly. Kind of just like what we're doing with buying online. Why Amazon's doing so well. Do you really need, some of these things that we buy, do you really need to go to an expensive mall that's paying through the nose, to rent space to buy something? One, it's a hassle getting there anyway. You got to get in your car, go there, and all that stuff. When you can just buy it online and have it shipped to your door. So I think malls are going to probably end up getting creamed by about 50%. Retail space, it's retail space. So office space is going to end up getting creamed.
Who's buying real estate in the big cities now?
I think rich people. Rich people, because and that's a good point, because you see that real estate is, in the United States, is almost as strong now as it was during the peak of the bubble in 2005 and 2006. And what's interesting about it, like California real estate, for example, is up 18.7% year over year. That's a huge price, rate of price appreciation, under these current economic conditions. But what is selling the most? It's the high end. It's the 1 to 2 million, Jim. And what we're talking about here is California uses median prices, so the mix comes into play there. And so high-end homes are selling way faster than low-end homes. Thus, the median price is going up at 18.7% year over year. If you go to some place to look at price appreciation like FHFA, Federal Housing Finance Association, and see how California's performing, it's not 18%, it's probably 9% in that range. It's half, because what they're looking is same home sales, so it's not influenced by the mix of housing.
Are people continuing to hold back on listing their homes and buying homes due to the COVID-19 fear?
Sure seems to be the case. They don't want strangers coming through their home right now. All these people that are so afraid of the virus that for example, let's look at the United States. let's look at the United States, then let's look at California. United States, I think sales on a year-to-year basis are up something like 25 to 30%, and inventory homes on the market are down something like 50%, Jim. 50%, and similar numbers in California. So sales are way up, inventory is way down. Now, the disclaimer that what we have to be aware of here, there's still 2.7 million homes, mortgage-owned homes that are in forbearance programs where people are not having to pay the mortgage. Not having to pay the mortgage. I think there's only something like 60,000 homes or something like that in the United States that are on the market. So there's a potential overhang out there of some percentage of 2.7 million homes that could hit the market real quickly if these forbearance programs, when they do end, because I'm almost 100% sure that many of those people are choosing not to make payments because they can't make payments. It's not a discretionary move. Flood of inventory hit the market. Huge. See, that's where you get. This is what happens when you get into a situation where you get into an economy that's on government life support. The allocation of resources, everything changes because the government says, we know what's best to do. You don't have to pay your rent. You don't have to pay your mortgage. And you can't evict anybody. And for missing either of those things. I mean, what are the long-term consequences of that going to be? I mean, who's going to make up that lost rent? That somebody's not paying. There's a lot of retail businesses, for instance. I was watching CNBC the other day, and they had a restaurant owner up there. This was about 2 months ago, and I said, "Yeah, we're doing okay. We're doing okay. We're holding our own." And I said, "How can you're holding your own with between 25 and 50% normal occupancy in your restaurant?" And he goes, "Yeah, we are." And then the reporter was smart enough to ask, "Are you paying the rent?" And the owner said, "We're working that out with the landlord," which translates into probably not. So what's that landlord going to do? I mean, he's got a mortgage, and all of a sudden, his income's cut in half. How come all these guys aren't bankrupt? I think there's a lot more bailing out going on, Jim, than is reported in the news. It's just happening behind the curtain. You don't see it. Federal Reserve's bailing anybody out. I mean, under conditions like this where businesses are down as much as they are, airlines are still operating at about 35% of normal capacity. How many airlines have declared bankruptcy in the last year? None. Delta's burning $25 million a month. How much money do they have? Where are they getting that money? Most people don't have that kind of money sitting around. I just talked to somebody the other day that owns a restaurant chain down here in Southern California. I think they have about, maybe 20. It's a privately owned company. It's called Island. It has a tropical theme like Hawaii. And I know the marketing manager that manages there. We run hills together. And I said, "How's business doing?" I said, "How's business doing today compared to when we talked 3 months ago?" She said, "Worse." I said, "Worse?" She said, "Worse." She said, "We're burning $2 million a month, to keep that thing alive." And my question is, who the hell has that kind of money? I mean, do you think a restaurant chain, with normal margins, where are they getting $25 million a year to stay afloat? Most people don't carry that kind of reserves. Nowhere even close. The average restaurant in the United States can go about 18 days without business before they're in trouble. And this company's burning $2 million a month, and they're still solvent. So there's stories here that aren't being told, Jim.
The presidential election is currently disputed. We're hearing rumblings that Trump will persevere and continue as president for another 4 years. What could that mean for real estate and the economy? Well,
that is an excellent question. Real estate is super expensive right now. So, you don't want to buy things that are expensive. You want to buy things that are cheap. And things that are expensive tend to go down. not up, that in the near term. So, I still think we're heading for a significant economic downturn, however this election thing is resolved, Trump or otherwise. I think real estate's still way overdone on the upside. If you look at cycles, especially here in California, which is very cyclical, there's a pattern that goes back about 30 or 40 years that tends to be, relatively consistent. 6 years up, 6 years down. 6 years up, 6 years down. Well, the 6 years up hit in 2019, and it started going down, and all of a sudden this pandemic hit in early 2020, and real estate prices took off like a rocket ship everywhere in the United States. It's the most unbelievable thing I've ever seen. That kind of turnaround. Why did people run to real estate? I mean, run to real estate when this is the most significant economic downturn in all of our lifetimes. Why did that happen? And nobody knows, but it happened. I mean, would anybody have predicted that? No, nobody would have predicted that. But it happened. So in other words, I think we're still in the ozone layer of valuation, and I think California real estate in the next, I would say in the next 12 months, will start heading down and probably correct anywhere between 35 and 40% before the down cycle's over. U.S. less will probably be around, I would say, maybe 20%. It'll go down 20%. And again, that's all based on cycles, historical patterns that have held true for 50 years, and for anybody to say it's different this time, that's a bad bet. A real bad bet, because I look at those historical patterns. And when in doubt, look, how's history performed? It's like democracies. I mean, are democracies permanent in the world? Yeah, right. Sure they are. Just go back in history and you say there's a shelf life to everything in the world, whether it's real estate booms, real estate busts, democracies, those kind of formulas. And so that's why that's why I find that these times are so exciting, because the uncertainty level is so high about what's going to happen going forward, thus the risk is so high. So people better be on their toes and just watch where their money, watch the trends and try to have their money in those trends and not in the right trends and not in the wrong trends, and they should do okay.
We'll have more with Robert Campbell when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Robert Campbell. Robert, the Dow's been trading above 30,000 points. The market performance looks like a case of don't bet against Trump. How is the Dow looking as we head into the new year?
Well, you're right. It's at record highs. Don't bet against the Fed. I mean, in the Fed, you look what's happened in the last year since this COVID thing got started. The Fed has injected $3 trillion into the U.S. economy. $3 trillion in 1 year. I mean, that is like shooting straight meth into an artery of the body. And that's what's happened. It's just all this, and others have been a lot of that's bailout money, a lot of that's stimulus money. So, we are in an artificial world right now. La la land. This is not a free market economy. Nobody's going broke. Nobody's going to go broke, and go bankrupt. The government's just going to bail everybody out, and so we're going to see how that goes. See, how that eventually turns out. It could turn out into roaring inflation, Jim. The money supply, even though I don't believe the government reports saying what they say. They go, oh yeah, inflation's 2%. We haven't had inflation in 20 years. It's been extremely low. Yeah, it's been inflation when you look at a broad range of goods, but you look at essential goods like housing, medical care, food, essentials like that. Rent is inflation 2%? Oh, hell no. It's much more than that. Much more than that. And, speaking of medical care, that to me is always the thing that I'm waiting for the next shoe to drop, because you go back 30 years, the average American household spent 4% of their household income on medical. Today it's almost 20%, Jim. So where's that money coming from? It's got to come out of somewhere else. The medical cartels, the cost of prescription drugs, the cost of just medical care has soared way out of line with normal increase in cost. It's almost as bad as college tuition. Look at how high college tuition is going. That's going to be something that I'm going to be interested to watch, to see how well these colleges do going forward. Who the hell wants to go to college? I went to college at UCLA. You know what I did at UCLA, 4 years at UCLA, besides getting a degree in economics? I played volleyball, dated a lot of women, went out and drank beer with all my buddies, and had a good time. And studying was down the list. I mean, was it a good experience? You're damn right it was a good experience. Social experience more than educational experience. Is anybody going to teach you how to be an economist coming out of UCLA? No. It takes 30 or 40 years to do that. But the interest was there. I graduated and all that. But now, once you take away that whole experience of going to college, of going out with sorority girls, of going to a football game and, a football game with the rest of the students at school, of going to classes and things like that, of drinking with your buddies and all that kind of thing, that whole social interaction. That's all gone. Who's going to pay $60,000 a year to sit in front of a computer and watch some class that doesn't teach you anything? That, to me, that's the next big crash that's going to happen. That what people are willing to pay for a college education. It's way, way, way overvalued, for what the benefits are.
We're hearing the next big challenge is America versus China, and we hear that China has bought up a lot of real estate, businesses, farmland, and even politicians. Could we see China trying to invest their American assets, and what could that mean for real estate?
Well, it's not going to be good for real estate, for one thing. And whether they that can't be good. And I can definitely see that happening. We're starting to come out. Who's the new boogeyman? At least here in the United States, even up there in Canada too. It's China. I think China is a bigger threat than most people want to realize, because they're clever, they're patient, and they do this slowly. But I think that the goal of Chinese is to rule the world and become the number one superpower in the world, and they'll do that by taking down the U.S.
What's the latest on California real estate?
California real estate appreciated 18.7% in November on a year-over-year basis. Things are still very, very strong, just like they are nationally. Sales are up like 35% year-over-year. Inventory's down 30, 40, 50% year-over-year. It's just unbelievable. It's pure supply and demand. There's high demand, low supply. But what's interesting again, it's the mix of the homes. It's the high end that's selling at the fastest, by a huge margin. And when I say high end, I don't mean, $600,000-$700,000 homes. I'm talking $1 to $2 million homes, Jim. That high end, the high end. And what the rich people own. The average price home, the median price home in California is $700,000 right now. $700,000. So what's selling are homes 2 to 3 times the median average. That's what's selling the fastest. And that's why the median price home of 18% year over year doesn't really truly reflect what's happening to the majority of homeowners. They may be only going up 8%, which is still huge, but it's not 18%.
How is real estate looking in the rest of the U.S.?
Real strong. Every place except New York City. New York City, they're leaving New York City in droves. Chicago's weak. I mean, because they've over, they're broke and people are leaving Chicago. And the weakest market in the country is the San Francisco Bay Area, because people are leaving that. What I don't understand is how can real estate in San Francisco City, I mean, when I said 18%, that's for all California. Real estate prices in the city aren't going up quite that fast. But when you have rents down 25% year over year, and there's, something like only like 55% of all Californians own a home. We have the lowest home ownership rate in the United States, so 45% are renters. So there's a lot of rental properties in California. How can you have rents drop 25% and housing prices keep going up? You think all those guys that own those rentals would be in default on their mortgages, and those things would be hitting the market like hotcakes. But they're not for some reason.
Can local and state governments cause dislocation in real estate markets?
Oh, absolutely. Absolutely they can. I mean, you look at what's happening here in, like, let's say Los Angeles. That they've got that place shut down, that people are just going to leave. And also local markets, what they're doing here, whether it's, I guess the state has taxing power, but in California, they have proposals where they're going to tax the super rich. When you say the super rich, I mean, it's not the $30 million, making $30 million a year. It's guys making $1 million or more per year. They're going to start taxing those people an extra 1 or 2% a year. That's what the bill wants. Jim, those people will leave. Business conditions the government that is interfering with everybody's business anyway. Here in California, income tax is 13.3%, the highest in the country. They want to raise it to 16%. I mean, pretty soon state income taxes are going to be as high as federal income taxes in some states like California because they're broke. They're super, super liberal. Everybody gets free money. You can be an illegal alien and they want to pay for your school. They want to pay for your house. They want to give you a computer. They want to pay for your health care. They don't even do that for its citizens. So, I mean, it's super, super liberal ideas. It's socialistic ideas. And like Margaret Thatcher said, she goes, socialism works great until you run out of other people's money, and which is so true. And what's going to happen to the state of California? Even though it's the most beautiful climate in the world, in the United States, so real estate is always going to be high, but that's not to say it can't come off 20, 30%, 40%, even 50%, and still be high priced, but the weather's not going to change. So some people will still want to live here, like me. I mean, I've lived in San Diego County, right on the coast for 73 years. I'm not moving anywhere. At this point in my life, I wouldn't move. There's no way I'm leaving the beach. This weather. The weather in San Diego County is the best in the United States, bar none. And anybody that's lived here agrees. They go, you're absolutely right. I mean, is it better than Florida? Sure, it's better than Florida. The only thing that may hold a candle to it would be Hawaii. But a lot of people don't like the humidity in Hawaii. I don't mind it. But I mean, Hawaii has a wonderful climate though too. But Hawaii's super expensive. Super expensive. The cost of living in Hawaii is the highest of any American city in the United States.
Are any of the U.S. housing markets flashing a buy or sell sign?
Well, they're all in rising trends. The sell signal, I have one sell signal for I cover 25 markets in the United States, 6 of which are in California. There's only one city that has a sell signal. That's the city of San Francisco. San Francisco City. Isn't that interesting? And it's because it became so overvalued, Jim. From 2012 through 2018, the median priced home in San Francisco went from $600,000 to $1.8 million. That's a little bit of a afterburner rise, right? It tripled in 6 years. Is that sustainable? No. So my timing model gave a sell signal on San Francisco back in September 2018. It was the first sell signal I got. And since that time, the housing prices in the Bay Area have gone up, maybe 3%, maybe 4% that time, nothing big, while the rest of the United States has gone up between 10 and 15%. So it's been the worst. The city of San Francisco has been the worst performing big city in the United States for the last 2 years.
Are people continuing to leave California?
Absolutely, they are. They're leaving California for two reasons. One, because that it's expensive to live here, and two, they're going after rich people's money, and it's too expensive to do business here, and they're just moving away. Elon Musk is moving out of California. I mean, he's one of the richest guys in the world. He's packing up and leaving. I don't know where he's going.
Mars.
He's already there.
Is mortgage lending by the banks more liberal or more conservative as we head into the new year?
It's more conservative. More conservative. In fact, even the Fed came out about 6 months ago in the middle of this pandemic, and they asked the banks to double the reserves. Double. So even the Fed's been shocked by this. Why would the Fed ask the banks to double the reserves? Would they ask them to double the reserves if they expect good times or bad times? Bad times. So I think a lot of people have been shocked by how this pandemic has affected real estate values. The stock market, not so much. The big Fortune 500 companies, all the companies that are listed on the S&P 500 and the Dow Jones and the NASDAQ, those kind of companies, the Fed has their back all the way. But I mean, how about, small mom and pop businesses? No, they're getting smashed. They're getting killed. So, and that's who makes up real estate markets, not Fortune 500 companies. So so in general, that's the case. The little guys getting killed, and the guys that with a lot of money that can pay into for re-election monies and that kind of thing, and afford big lobbyists, they're doing just fine. Their stocks are at record highs. Most of these companies are still all this money that they're making, that they're still engaging in stock buybacks. They're buying their own stock back with money, which keeps the stock market elevated. That hasn't eased off a bit. I expect a huge stock market. I expect a major correction in everything. I mean, can I tell you exactly when that's going to happen? No. But I'm following this stuff on a month-by-month basis, not day-to-day, monthly information, and I know that things that are overvalued tend to come back into reality at some point in time, and that time is approaching. It's going to happen. This was something. Let me see if I can find this real quickly. This was from Jeremy Graham, who's one of the smartest market guys around. Because the one reality you can never change is that a higher priced asset will produce a lower return than a lower priced asset. You can't have your cake and eat it too. You can enjoy it now, or you can enjoy it steadily in the distant future, but not both. The price we pay for having this market go higher and higher and higher is a lower 10-year return from its peak. And that's exactly where I see happening. Nothing is cheap. And that's why one of the asset classes I like the most, maybe the most, is commodities. Commodities are like a 50-year low, and they're starting to rise. You should buy. I mean, does that mean commodities are going to stay cheap? No, they're not going to stay cheap. So you buy things that are cheap and hold them until they go high, and then you sell the high-priced stuff and buy something else that's cheap. That's called value investing. And I do the same in California with real estate, because the prices are so cyclical. It's the perfect place to time real estate markets because the cycles are so extreme, both to the upside and the downside. And so that's what you want to do. I mean, the golden rule of investing, people that go buy and hold, buy and hold, buy and hold, all the guys that tell you that, they forget one thing, Jim. One thing. Is that when the market's down 40 to 50%, does the average guy whose portfolio is down 40 to 50% feel good about things and feel like holding, like, oh, it's going to come back, it's going to come back? No, he doesn't. He reacts to his emotions of extreme fear and he sells. Nobody tells you that, though. They just tell you, oh, just hold, you'll know it's come back. Yeah, tell me not to be afraid when somebody's pointing a gun at my head. No, you don't. They don't tell you that. And that's why the golden rule of investing is to buy low and sell high. And I've always believed that, that money that's correctly managed is better, will deliver not only satisfactory returns financially, but even better returns emotionally. Most people can't handle down markets, and nobody talks about that, Jim. Nobody talks about it. I've seen it firsthand. During the last market downturn, the Jim, there was, I'm friends with some retired medical doctors, and they, all their portfolios, they had $5 million, $6 million bucks. Doctors have made a lot of money if they've been in the business for, 50 years. I mean, a lot of money. Their portfolios worth $5 or $6 million bucks. Okay, all of a sudden their portfolio was worth half of that. Do you think they just sat there and did nothing and held? No. Half of them sold out at the bottom and to save their, so that they'd have $3 million, so they'd be safe. But did they buy back in when the trend turned? Nope, they didn't. So that's what they don't tell you, is that human nature plays such a huge role in your success in investing, because most people can't handle the downturns. They get scared as hell. And when people get scared, they run. And they feel pain. And how do you stop the pain? You sell. And the pain's gone. Pain goes away. And that's human nature. And that's one thing you can never change, and you just can't say, oh, just hang on. I know your portfolio is down 50%, but it'll come back. I mean, yeah, has it come back? Yeah. But I mean, is there a lot of pain in the meantime? I mean, of course there is, and people don't like that. So that's why I'm more of a believer in playing the cycles. Buy what's cheap, sell what's high, and just do that over the course of a lifetime. Nobody's ever gone broke from buying low and selling high. Nobody's ever done that.
We're hearing both the bull case and bear case for gold and silver. What are your thoughts on gold and silver in these crazy times?
Oh, I continue to think gold's going to be the best performing asset over the next 2 or 3 or 4 years. Yeah, I think it is. I think all this debt that they're creating, and that all this debt the Fed has to create and the government has to create to stay solvent, somebody's got to own it, and pretty soon they got to start backing this stuff with something. And I think they're going to revalue gold to a big number, minimum $15,000 an ounce, to say the dollar's backed by that, to keep people's faith in the U.S. dollar and its debt markets. The debt market is 4 to 5 times as big as the equity markets. So when the debt guys get scared, nobody wants to buy the debt. The only person left to buy it is the Fed. And so, I mean, and that's not a free market situation, and there's no free lunch situation there. But so if you back the dollar by, let's say, 20% gold, 25% gold, or something like they did, you would restore confidence in the U.S. dollar. People would still hold the debt, because what they can't do is have everybody run away from the debt, from the dollar, from bonds, because interest rates will go from 3% to 15% in a very short period of time. The U.S. would be broke. Its debt servicing would go from about 7% of GDP to something like 25%. I mean, and there's no way in the world that we can handle that kind of debt servicing with the amount of debt that's on the market. So I think to save the debt market, which will be to save the country, they'll have to find some way of backing the U.S. dollar with something everybody believes in, and I think that's going to be gold.
Does the value of the U.S. dollar have an effect on the price of real estate?
Not really. They're not correlated.
Is there a push towards socialism and communism in California?
Oh, absolutely. Absolutely. I mean, they want, they're trying to create a socialist, not only in California, in the U.S. They want everybody to have, the Green New Deal kind of a thing, and central control, where one government, kind of like what they've done over in Europe with the EU, where, central government controls 27 different countries. Well, they want to get government to be bigger and bigger and bigger and bigger, because they know best. More and more government control over everything. And what is so crazy is small business in the United States constitutes something like 70% of the U.S. GDP. 70%. Only because there's so many of them, Jim. These Fortune 500 companies, yeah, they're big and huge, but there's only like 500 of them, or 1,000. You know how many small businesses there are in the country? Zillions. And so when you start killing small business off like that, you got a real problem on your hands. And that's what these guys are doing. Guess how many of these guys that are telling us what to do. Like, I've been self-employed my whole life. My dad was self-employed his whole life. So the apple doesn't fall too far from the tree. Guess how many of these politicians have ever owned and operated a small business on their own? 0. They have no idea what they're doing. And they're totally mismanaging things. And if you lose the little guy, you're done. All you got left is socialism. Take from the wealthy and give to the people that don't have jobs so that they don't starve or revolt.
Is the U.S. likely to see more violence and unrest following the inauguration, and how could it affect real estate and the economy?
I think whoever becomes president, whoever that person is, that it's only going to get worse from here on out. It's going to get worse. The division in the United States has never been greater. It's not the United States of America. It's the divided states of America. When I was going to college, I grew up during the Vietnam years, and we had our protests. Believe me. They pale into comparison to what's going on right now. I don't care if you were pro-Vietnam War or anti-Vietnam War. Everybody smoked pot together and at least got along. That's not the case today. People don't get along. The left hates the right, and the right just wants to follow the Constitution and all that. So I'm pretty bearish on the state of the U.S. economy, where we're going from here, the state of the country. I think there's going to be some huge readjustments coming, and I think social unrest is going to increase. And I would put odds 50-50 on a civil war. I mean, and everybody says, "Oh, that's crazy." Go read some history books. See how crazy civil wars are, or where the United States, divides up, where the conservatives, take a certain number of states and the liberals take the other number of states. I mean, that's happened in Czechoslovakia. That's what happened in Russia. Nothing in life is permanent. That's what I've learned. One thing I've learned, I've been on this earth 73 years, and would I have thought like this when my IQ hasn't changed from the time I'm 35 to the time I'm 73. But you know what has changed? I've become a lot wiser to the ways of the world, and I know that nothing's permanent. And so you got to be on your toes the whole way, Jim. Nothing is safe. I mean, it's not like you're walking around paranoid, but you just have to realize that things can change dramatically over time, and you have to be ready for it. And that's just not like making a declaration that's untrue. You take out of 100 Americans, adults that reach the age of 65 years old, only 5% of those Americans are comfortable financially. 95% are not. They depend either on a small pension, Social Security, some type of government bailout in order to exist. That means if getting ahead financially and staying ahead financially was so easy, why do 95% of all people fail? Because it's hard. It's hard. But that's the magnificence of it. It's just, I'm sure it's hard getting to the major leagues, playing baseball. But do some people make it? Yeah. Are they good? Yeah, they're real good. And that's where you want to be. You want to be a major league player in the markets, in life, so you're one of the guys that survive. And to me, I look at it like it's a magnificent challenge, Jim. Magnificent challenge. Because you have no control over what's going to happen in the future. The only control you have is to adjust to changing market and social conditions and just hope for the best. No guarantees. And so that's what I've learned over time. That's the wisdom of a 73-year-old. And I have a lot of followers after being in the business 19 years. And people know that I've been telling them all along, you can never be complacent about where you are financially in this world, because things can change dramatically. So I'm certainly not one of these wealth merchants that tells you that, how easy it is to get rich and stay rich, even with no job, no money, no brains, and a crappy credit report. Those programs sell like crazy. Do they work? No, they don't work at all. but they sure sell because that's what people want. So pretty soon that you just get to the point and you just go, look, guys, it's a fight. It's a fight all the way. And so you just have to be prepared to do battle and protect what you have. Protect what you have. Not saying that money's everything. Health is the most important thing. You know, never trade money for health. I mean, but you don't want to be poor either. You don't want to be, you know, you want to be comfortable financially. And to be comfortable financially, you don't need 10 or 20 million bucks. Not even close, you know. Not even close. You have a couple $1 million and know how to live frugally and live frugally, you'll be fine. You'll be in the top 2% of all Americans if you can do that. So all these guys that tell you, oh yeah, you need $10 million to retire well. No, you don't. Don't be stupid. You know, yeah, if you need to spend $250 a year, $1,000 a year, in order to survive, most people don't need to do that. Not by any means. You know, most people aren't traveling the world in a 150-foot sailboat. You know, that's not what people look forward to at retirement. That's for rich people only, super rich people only. So and as you get older, especially when you get older, that the key is don't lose what you have. You got to be even more conservative. Okay, let's say you've made a couple $1 million. You've gone through life and you made a couple $1 million. I know that maybe that doesn't sound like a lot, but that does put you in, you know, the top 1% of all Americans. So that your key is not to lose that money. Are you going to have to move the money from time to time to make sure that those assets don't go down in value and you maintain your purchasing power of the wealth you built? Absolutely. But are you going out there? Is your goal to turn that $2 million? Let's say you're 65, 70 years old. Is your goal to turn that $2 million into $4 million? Will that make you twice as happy? No, it won't make you twice as happy. And you could easily turn that $2 million into $1 million or $500,000. You know, now you have a problem. Now you can't live the life that you once thought you could live. So you got to start protecting your money. You got to start protecting your money more carefully as you get older. It's like Bill Belichick. Bill Belichick's one of my favorite players. He's the coach of the Boston Patriots. He has 6 Super Bowl rings. When he started out in football, he was a defensive coach. He worked for Bill Parcells on the Giants, who won 2 Super Bowls. He was the defensive coordinator. He was the brains behind, a big part of the brains behind the Giants winning 2 Super Bowls. Bill Parcells nicknamed Belichick Doom. Doom! And you know why I nicknamed him Doom? Because Belichick was always worried about what could go wrong. Well, now that he has 6 Super Bowl rings, how has that defensive orientation worked for him? It's worked like magic. It's worked like magic. He's always wondering about what can go wrong. Most people don't focus enough on that, Jim. And that's where the problem lies. Risk management is foreign to most people's thinking. You know, and it shouldn't be foremost. It should be foremost. Defense wins championships. Offense gets the headlines. Defense wins the championship. Defense is what's going to take you through life where you're solid financially. You know, yeah, you may not be running around in a new Lamborghini every year, but you're not going to be poor either. So, I mean, that's where most people want to be. You know, most people put way too much emphasis on way too much focus on making money as opposed to preserving money. You know, it's a 2-part equation. And like I said, I'm 73 years old, and did I know this when I was 35? No. Has my IQ gotten doubled since I was then? No. But like my dear old dad used to say, who was in the building business for 55 years, he said, don't take advice from anybody that's under 50 years old because they haven't had their head in the cement mixer enough times. And that's the truth of it. With age comes wisdom. If you got a brain in your head, you think guys like Warren Buffett that has $70 billion, you think he's aware of what can go wrong? Yeah, if he lost half his money, he'd only have $35 billion. Okay, yeah, I don't feel sorry for Warren Buffett. But I mean, if Warren Buffett had $2 million and lost half of it, you know what he's going to feel? You know what he's going to feel like? He's going to feel like blowing his brains out. He's going, how stupid can you be? I lost half my money. I mean, if you don't have $2 million, let's say you have $1 million and you lose half of it. Now you have $500,000. And let's say you're 65 and you're going to live another 20 years. Can you live comfortably on $500,000 with no income coming in, or little or no income coming in? No, you can't. Now you're going to be now you're going to be struggling for survival. Which it's better than not having $500,000. But when it comes right down to it, the average American retiree has about $200,000 in net worth. $200,000. Now, if he lost half of that, now he's got $100,000. How far is that going to go? Not long at all. Not very far. So it's defense. That's why I tell people, be defensive. And as far as right now, people said, should I buy real estate in California? And my answer is no. No. I said, wait until prices come down. And how long are you going to wait? I don't know. I don't care if you have to wait 6 months or 6 years. Wait. Because there's no better way to buy real estate, to buy any asset, that's when its price is depressed. Because what's the risk? It's the risk of like falling off a curb versus falling off a 10-story building. So those times are worth waiting for. And if you just live your life with that kind of attitude, you'll just, let's say you go through 70 cycles in the course of 70 years. You'll do just fine, Jim. But most people are impatient. Everybody wants to get rich quick. Super quick, thus the how to get rich quick, formulas that are out there. I've seen those guys come and go over the course of my lifetime, and they're still selling the same course year after year after year because they don't work. People have a tendency to buy when prices are high, not when they're low, and that is the biggest mistake the average investor makes. So all of a sudden, if you buy when it's low and then ride the trend up higher, sure, you can go ahead and sell when it's high and take your profits if you want. But I'll tell you, even if prices start declining, from the peak values down, they're not going to go very unlikely to go all the way back down to the low point where you bought them at. I mean, that's just not the way life works. So you have a huge safety margin built in. You have a huge safety margin built into your portfolio when you buy assets when they're cheap. And that's why those times are worth waiting for. Just do something else in the meantime. Get a dog.
Are some of the states likely to get back to normal soon while others will not?
Yeah, I think so. I mean, and the states that are not are California. California's not. New York's not, because everything is too expensive. Rents are too expensive. Real estate's too expensive. And they have super liberal governments where they're passing out money and they keep raising taxes and expect, that the common man, to pay for the privilege of living in these states. Also, some of these places, especially places like some of these major cities like New York City, I mean, the social unrest has grown and grown and grown. It keeps getting bigger every year, and people don't want to live around that. And so that's, the three states in the country that have the biggest amount of out-migration in the United States are New York, Illinois, and California. No, there's a net out-migration of people leaving those states, and that's not good. New York, they're fleeing like crazy. So, I mean, that nothing's permanent. They're all moving to Florida or some other place, safer place. They don't like the economic situation. They don't like the political situation. They don't like the lockdowns. That type of thing. And people are starting to protest. People are going to stand up against this eventually. And that's why I'm pretty bearish on what's going to happen going forward. I think we're confronting a major confrontation in this country, where the powers are going to get challenged. No, you can't tell me to do that. No, that's unconstitutional. I'm not going to do that. And so, what are you going to do? Put everybody in jail? Or all of a sudden you're going to back down? And I think that time is approaching. I think we've reached that point. I think we've reached that point in our country where, and it's primarily driven about the death of socialism. That people can't pay. People aren't living within their means anymore. And especially these countries, these states, and they can't afford it. Now they have to jack up taxes to pay for all these programs the politicians have created in order to buy votes. and it's become overwhelming. That's how democracies die. That's how they die. Study history. Because all of a sudden, the politicians that in a democracy, they get bought off. They get bought off by major corporations and big business for political favors. They do well, and the rest of the economy sucks. And so they have all these programs. And what's a better way to buy votes here in California than let all the illegals in and say you can vote? Hey, there's another 5 million. There's another 5 million votes right there. I mean, and that's what they do. And so it's in order to buy votes to stay in power and give them more money. Just give them more money. The one guy says, if I get elected, I'm going to pay you $1,000 a month. Just free money, just to survive. And next guy comes in and says, I'm going to pay you $2,000 a month. I mean, that everything else being equal, you know which guy's going to win? The guy that pays you $2,000. I mean, can you afford it? No, but that's going to get you elected, and that's kind of where we are. You know how this can all be solved, Jim? Term limits, which will never happen because Senate has to vote on it here in the United States. Limit everybody to one term, 4 years, 3 years, 5 years, whatever it is, and that's it. You come and you go, because then they can't get in the pockets. Then major corporations can't get in the pockets and these lobbies of all these politicians because they're gone. By the time they figured out who to pay off, the guy's out of office. Term limits. So, frankly, guys, I mean, everybody listening, I think these are super, super exciting times because change is that the ability to successfully adjust to change is what Charles Darwin talked about in Survival of the Fittest. It's not who's smartest, it's not who's strongest, it's he who successfully adjusts to change the best. Those are the guys that survive in the long run. And I think we're going to get tested here in the next 1, 2, 3 years. And I think we're going to get tested very strongly. But I mean, that's nature. That's the law of the land, the law of nature. The strong survive and the weak don't. I mean, we're all animals, human beings too. I know that we're not out in the with the coyotes and the rabbits and the hawks where I live. You just go inland a few miles and you're in the canyons. You see the law of nature at its finest. Everybody's a predator to everything else, and everything seems to work fine. I mean, that's just nature, and that's what's going to happen in the United States. I think we're in for some big, big, big adjustments. The status quo is not going to survive anymore. We're not going to be a country that's happy as a whole, where we embrace each other and respect each other's opinions, allow freedom of speech happily. You're entitled to your opinion. One of my favorite sayings, favorite sayings nowadays, and I've learned this, is when I'm discussing somebody that's controversial. I tell people, and everybody, use this, and you'll see how well it works. I have an open mind. Convince me that you're right and I'm wrong. That disarms people in such a pleasant way. Just say, prove that I'm wrong. Don't sit there and argue about something with no facts. I have an open mind, and I do have an open mind. I've prided myself in having an open mind and not having a closed mind. Just convince me that you're right and I'm wrong, and then just shut your mouth. Most of the time, those are very short conversations, by the way. So what else can we talk about?
A pro and con comparison, California versus Florida.
Well, I've spent a little time in Florida. I like Florida because I don't mind the humidity. I like the heat. I think California has better weather than Florida. And it's all about the weather. We don't get hurricanes. We get brush. I mean, that kind of thing. And I don't know that. I'll tell you the difference between California being on the coast. California has a beach boy element to it. Florida doesn't. It doesn't have that beach boy. Hawaii has a beach boy element to it. So, I mean, you might want to move to Florida because, the housing prices are significantly lower. But, I mean, is the weather better? No, it's not better. We have no better weather in the United States than in Southern California. It's the best in the United States. So, I mean, it depends why you're making the move. I'll tell you, let's say that I'm 65 years old and retired, and all I have in California is a free and clear house. The median price house was $700,000 somewhere. If you live on the coast, double it. You have a house that's worth $1 million, let's say, and that's all you got. I'd sell my house in California and move to Florida because you could replace that house in Florida for about 1/3 of what you sold your house in California you had here, and you'd have $600,000 extra to live on until you die. I mean, that's a good reason to move. I mean, would I move there because Florida has better climate, better economy, better people than California? No. California's a special place. And I've lived here for 73 straight years, so it's not like I just moved in and say, wow, this place, what a great place. So, I mean, I wouldn't move from California. I wouldn't move from the beach. I'm not leaving the beach. I mean, if I lived in Bakersfield, maybe I'd move. If I lived in Bakersfield, I would have moved a long time ago. But I'm not leaving San Diego. There's just too many cool people. Too many good-looking women, Jim.
Do you have any health tips for us?
Oh, yeah. Health. Main tip is this, guys. Don't ever put money ahead of health. Ever. That's a dumb trade-off. Always take care of your health, because if you're in good health, that's going to help every single aspect of your life. You're going to feel better about yourself. You're going to do better in business. You just feel good. You're in shape. You're strong. You look good. You're trim. It affects everything. Your attitudes, your confidence. People can see it in your face. You have confidence. Do you want to deal with somebody that do business or go out with somebody that's confident or somebody that's not? The confident people. And so that's why I think it's the best thing that you can possibly do is take care of your health and do what it's going to do. In fact, I've been giving real estate seminars for the last 18 years. My next seminar is going to be, I think, and it could be future seminars as well. It's going to be titled On Wealth and Health. Wisdom of the Ages. Because I've been walking this walk for 50 straight years, Jim. There's so many things that I've learned that I could share with people, whether they follow, my advice or not, my suggestions or not, that's up to you. But I can tell you firsthand what works best and what doesn't work. And if you want to use that to your advantage, not only in the markets making money, my advantage about making money is to buy low and sell high. But as far as health, what do you do? Here's what you do. I mean, so many little tips. Like one of the tips that I have is I haven't had a cold in 5 years. Why? I started taking 25 milligram zinc tablets every day for the last 5 years. I used to get at least one cold a year. And everybody knows getting a cold sucks. And it just happens. I haven't had one cold. And zinc prevents it. And I found out about it, just through research and study, and experimentation. And so I just keep taking zinc. And is it expensive? No, it doesn't cost anything. But it keeps you from getting cold. And by the way, zinc is one of the main ingredients in the grandma's formula for avoiding the flu or minimizing the downtime when you get the flu. Whatever those things are called. I'll never get the flu. I mean, I haven't had a flu shot in 25 years, and I haven't had the flu in 25 years. So, I mean, it's just like the healthiest thing you can do to avoid getting disease is to be in good shape and be healthy. That's it. Biden was saying that, my first 100 days in office, everybody's going to wear a mask. If I was president, what I'd say? Screw the mask. For this next 100 days, I want everybody to work out every day and eat good food. That would be 10 times more effective at controlling any kind of flu or cold or disease. It's your number one defense. My personal doctor, I've had my last two physicals. I have a full physical every year with a blood test with about 40 items on my blood test that I've ended up with because I want to know what they are. And in the last 2 years, my primary doctor said, Mr. Campbell, if all my patients were as healthy as you, I'd be out of business. And I said, thank you. And he goes, you're in great shape. I said, keep it up.
Any more words of wisdom for us?
Well, I mean, all these words of wisdom are that, that everything that I've given you. And the words of wisdom, here's what I'll tell all you guys. You can be 35 years old and smart. You're not going to be 35 years old and wise. Wisdom comes with age. And so either you're going to learn half the things you're going to have to learn on your own. I mean, you're not going to learn it from anybody telling you, your parents or me or something like that. But what you're going to do is as you live your life, you're going to realize it's not as safe a place as everybody wants you to believe. And so therefore, you just become more defensive about what you do, more careful about what you do. I mean, you take care of your health, you take care of your money, and it's not like you're running scared, you're just acting smart, because you have wisdom. You know that nothing is permanent, that wealth has wings. And so you have to fight to keep it, and it's a magnificent fight. It's a magnificent fight. It's not like it's a fist fight every day with some blood or crip in the LA hood or something like that. But anytime you got to do something, you go, should I do this? No, I'm not going to do that. Like, could I afford a really nice car, like a $200,000 car? Yeah, I could afford a $200,000 car. Is that how I'm going to save and spend my retirement money? No way. I don't need that. So, I mean, you just look at it like that, that you find other ways of gaining satisfaction. Hey, I'll tell everybody there something, what I'm doing to stay young, and young at heart. I'm 73 years old, right? I'm in spring training right now. I'm going to join an over 65 hardball league. Over 65. And all you guys out there, how many guys do you know that are over 65 can play hardball on a baseball field? Hit a ball, field a ball, throw a ball like that. See, that's one of the things I want to do, because it's a goal it's hard work to get to that level. But as long as you never get bored with life, if you always have something out there that's bigger than anybody else is doing, and something like playing hardball at 65 years old, that's a magnificent goal. And the problem I'm having, I can't find anybody to practice with. The guys I know that are 65, they can't even throw the friggin' ball across the room, let alone field it. And most of the young guys, that play like, college and high school baseball, do they want to play with a 73-year-old guy? No, they don't. So I don't know. I'm getting there, though. I'm practicing with the kids, but it's going to be, and what's interesting in the over 65 league here in Southern California, a significant number of those players are ex-Major League Baseball players. So that's the competition. That's the level, guys. And so because I've always loved baseball. Maybe it's not baseball that you do. Maybe it's something else. Maybe it's some other idea that'll keep you young and all of a sudden keep you in shape. I mean, you got to be in good shape to play baseball. I went out and practiced for an hour and 15 minutes the other day. I was sore all over. I was tracking down fly balls, I was fielding grounders, I was hitting pepper, and we were throwing the ball. I mean, it was a good sore, but, I mean, you gotta do something like that, everybody, when you get older, because it's a proven fact that if you get to be age 65, and you've worked at the same company for 50 years, and all of a sudden you retire, and you don't do anything with your life, versus somebody like me that's going to play baseball at a high level at age 75. Somebody like me I will live on average 2.4 times more years than the person that does nothing, that babysits his grandkids. Isn't that interesting? So if you just retire and think, I just love my grandkids, or I'm going to travel. You know what? I mean, traveling's okay, but is there any challenge in that? No. I'd love to see if I could hit a 65-mile-an-hour fastball still. I mean, are my eyes as good as they used to be? So it's always those kind of challenges, everybody. Challenge yourself to do better. I mean, and physically is a great way to do it. I mean, that maybe I have a friend that's 70 years old that still surfs. And I said, how many 70-year-old surfers are out there? And he goes, me. And he goes, here's where the difference comes. He goes, when I was younger, Bob, I would surf any wave. Like 8-foot wave, 10-foot wave, no problem. I mean, California doesn't have huge surf like that most of the time. He said, I won't surf those waves anymore. He says, too dangerous. I mean, it's just, I'm 70 years old. A 10-foot wave's a big wave. That's like double overhead. And if I screw that thing up and I get in a problem, he said, I could get hurt and die. He said, I don't need that. He said, I'll surf 6, but no 6 or 8. So you gotta be realistic about that. But he's still surfing at age 70. That's what's gonna keep you young, everybody. That's what's gonna keep you young, keep you engaged, keep you in the game. Well, that's what you're talking about, Hey, surf was big the other day, and he's been surfing so long, I forgot that he's 70 years old. I said, and I didn't even know. I said, because I don't surf. I've surfed 50 times, but, surfing's not my thing. I'd rather play baseball or something. But he's surfing at 70. Or maybe you can go out and run a marathon when you're at 75, if you like running or something like that. Or do something. But that's what will keep you alive. That's what will keep you interesting. And you'll be so engaged with life, and you'll have so much energy, and just to keep pushing you forward. And it's all about bragging rights. I was running down the beach my wife and I were on the beach the other day with our dogs, and there was some young kid, looked like a college kid. He was throwing a football up in the air all by himself. And it was a nice football. I could tell it was a good football. You could see the white laces. It looked like a pro football, it wasn't a cheap rubber ball. And I said, hey, throw me the ball. He said, threw me the ball. I said, go out. And I hadn't thrown a football in like 6 months. I said, go out. And he said, all of a sudden I threw my first ball, and it was such a shitty throw. It was unbelievable. And I went, hey, let's try that again. So I said, give it back to me. And I said, go out. I said, keep running. I said, keep going. I threw like a perfect touchdown strike to him, as far as I could throw a football, now then. And so I looked at my wife and said, still have it, baby. Just the ability to say that, everybody, it makes you feel good. It keeps you young. It keeps you alive. It keeps you vibrant. You're healthy, does it cost any money? No. We're comfortable financially. So that, I don't need to, my goal in life isn't to double my net worth. My goal in life is to be the star player on an over 65 hardball league. That'll double my happiness. That will double my happiness if I can do that. I'd love to have those kind of bragging rights. Not that, I've made this amount of money. No. I could care less about that at this point in my life. How far can you throw a baseball? Oh, I can't. Too bad. So that's kind of the way you want to live your life. It's not just about money. Money's important. Take care of it, everybody. Take care of your health too. That's even more important. But then as you get older, engage. Stay, especially nowadays with this friggin' digital world we live in. There's no face-to-face engagement. You're not going to play baseball on a video machine, my friends. It's out there. There's going to be a pitcher, and he's going to be throwing a ball, and you're going to hit it, and you're going to run. And somebody's going to be out there trying to feel it. It's the real deal. It's the real game. That's where life is, out there doing that kind of stuff. One guy I follow, Laird Hamilton, he's 56 years old. He still rides 80-foot waves. That's a big wave for a 56-year-old guy, Jim. He's my new role model. So I look for role models like that, and that's what I try to be to my followers. And hopefully some of the people that are listening in on this podcast, to inspire them to be, better than they can be, and just to put a smile on their face. Hey, look what I can do. Hey, that's pretty cool, man. That's pretty cool. You could throw a football, 40 yards, and you're 60 years old. That's great. Will that get you to the NFL? No. That won't even get you to a high school game. But if you get to be 65 years old and you can throw a football 40 yards to someone, hey, you're doing really well, my friend. That's great that you can do that. And you're in a league all of your own. So you kind of create your own happiness and what you're proud of and that kind of thing. And it isn't collecting money. Believe me, it's not collecting money, guys. No, once you have enough to be comfortable. When I was young, when I was 35, I wanted to own the most expensive home in Rancho Santa Fe. And that's a very exclusive area down here in San Diego. You know what? Reality intervened in between. After a couple divorces, after a couple real estate down cycles, after this and after that, you go, holy cow, that's pretty hard to do. You go, yeah. So maybe aspiring to own a home in Rancho Santa Fe is too great a goal. It isn't worth working for. Instead, you'd rather work for something a little more modest, take care of your health, and become a baseball player. Replay baseball at age 75 and stuff like that. So it's just not about money. Just don't even think about, get comfortable financially. Live within your means. I was raised in a really, really, my father was a really good role model for me. He was a Marine in the World War II in the South Pacific. So he knows about survival. He was a kid during the 1930s, grew up in the 1930s. He knows what it's like to be frugal. He told me, he said, never borrow money for anything other than real estate that you can't write a check for. Is that old school today? Damn right it is. It served me well. It served him well. You know, he developed real estate for 55 years and never went broke. That puts him into a very elite crowd of individuals because he was trained right. He was a Marine. He trained to take care of himself, to survive. He grew up in the 1930s, and he knew what tough times were. He wasn't going to let that happen to him again. And slowly, was he super wealthy when he died? No. Was he comfortable financially? Yes. Yes, he was. So, I mean, that's the kind of thing. Just set goals that you can achieve that are modest, and don't say that my goal is to make, $25 million. Trust me, that's not going to make you happy. That's not going to make you happy. One doctor friend I know, he dealt in a very exclusive area that we live in down here. He had a medical practice for 30 years, and he said, and I got to know him in the gym, and he said, Bob, I have a lot of very, very wealthy patients, and I'll tell you something. Every one of those patients would trade all their wealth to be in the kind of health you are. And that's one of the 10 or 20 things that people have said to me over the years that I will never, ever, ever forget, Jim. Said they would trade all their money, all of it, to be in good shape, to have your kind of health. And it's something, you can't disregard your health for 65 years and say, okay, I'm going to get in good health. No. You got to start early. Wasn't that interesting? He would say something like that to me, and I've never forgot that. That's one of the 20 top things. And I said, I always remember him saying that. And so that always keeps me focused on never, ever, ever let down on taking care of your health. Ever let down. I work out like 2 hours every day. Do I miss some days? Yes. I missed yesterday. But my rule has always been for the last 50 years, you can miss, but never miss 2 days in a row. I mean, little things like that. Because you can't let it turn into a habit, a bad habit. Oh, it's 2 days, it's 3 days. Oh, now I'm in bad shape. And you just let it go. Now you don't work out anymore. You can't do that. So that's kind of my new goal in life, is to help older people, like me and people that are 60, 65 years older, help them achieve the kind of things that are really going to make them happy, really make them healthy, and along the way, show them how to make high returns in real estate with low risk, with low risk, and that's the way you do it. You do it by buying low and selling high, and you'll have enough money to survive, to live on. So that's my wisdom, my friend.
How can people find out more about your newsletter and your book?
They can go to my website, realestatetiming.com, just like it sounds, realestatetiming.com. You can buy my book. It's $35. And you can invest in my newsletter. I'll give you my book for free if you sign up for my newsletter for a year, which is $135. And it's that's what you can do. And that's another thing you want to do, you guys. I mean, look, I will never retire. I can do this until I die because I'm really, really good at it. It's like, I don't put myself in the same boat as Warren Buffett, other than the fact that, does Warren Buffett need more money? Why does he keep playing the stock market game? Because he likes it. I like what I do. Whatever you do, guys, do something that you like. If you hate your job, quit. Do something that you like. Because eventually you're more likely to perform well at something that you like than something that you don't like. And so all of a sudden you're in retirement, and most of my people that know me, they say, you don't work, you're a semi-retired beach bum. I said, I just don't have to work as hard as most people. After I've been following certain key real estate indicators for 20 years, I can tell you what the trend is, looking at certain data within 5 or 10 minutes. I don't have to do all the research I had when I got started that took me years and years and years. So you just get better at it. It's like learning how to hit a baseball. Once you get to the major leagues, do you think you have to go out and swing the bat, hit 1,000 balls every day to stay good at hitting a ball? No, you don't. You already know how to hit a ball. Maybe you might have to hit 50 balls a day, to keep everything sharp. But you don't have to hit 1,000 because you already know what you have to do, what to look at to hit the ball well and stay in the major leagues. So it gets easier with time, everybody. It gets easier. So, and that's how you can find out about me and, what I do. I have an amazing business that's, and amazing followers that been with me. Most of my followers have been with me for, minimum 10 years. I have people that subscribe to my timing letter that don't even invest in real estate. They just like the way I think. And does everybody always agree with everything I say in my timing letter? No. But I'll tell you one thing. They all want to know what I have to say because they know it's all based on data, and I'm way more likely to be right than I am wrong. And so that's the kind of business, and you don't make false promises to somebody. You don't guess about what the future holds to a large degree. You're just basically, tied in to data, and data that's highly correlated with price movement, and the market's its own best forecaster if you know what to look at. You don't have to guess, just follow certain key indicators that have a high probability, high correlation with price movement. And there you go. Now you're better than most people. Now you got an advantage.
Robert, best of the season, and thank you so much for chatting with us.
Okay, you take care. Thank you again. Merry Christmas to everybody.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. He was speaking to us from San Diego. Coming up, Wolf Richter next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf, and best of the season.
Hey, thanks, Jim, for having me back.
With millions of people still out of work in the U.S., how are people handling their credit card debt?
Yeah, that's an interesting and somewhat unexpected development. There's two sides to a credit card. A lot of people use them as a payment method, and that charge all kinds of things on it, and they pay it off every month. And so these credit cards, they don't accrue any balances, and the bank itself makes money off of the transactions. So the bank collects a fee for each transaction. So the bank benefits by you using the card, even if you pay it off every month. And then there is another use for credit card, and that's where people actually borrow money on a credit card, so they don't pay it off every month. They make a minimum payment or make some small payment, and they start accruing balances. So the bank makes money not only off the fee per transaction, but also off the interest that it charges. So the interest on credit cards, even today when interest rates are at near zero for short-term borrowing, and when investment grade corporate bonds yield below 2%, credit card interest rates have really not budged. They're up there. They're in 15, 20%, 25%. There's 30%. There's a usury law. The usury laws in the U.S. that have been basically dismantled, and so banks can charge essentially whatever they want to. And so these people that borrow on their credit cards are paying huge amounts of money in interest to the banks. So for a bank that is in a zero interest rate environment, this is a huge profit center that they have, and it's very important. So I'm saying this because the Fed follows this very closely. The Fed in the United States, is responsible for the banks. It's the regulator of the banks, and the 12 regional Federal Reserve banks are owned by the financial institutions in the district. So the New York Fed, for example, would be owned by the different financial institutions in the New York district. And so this is hugely important to the Fed. And the Fed wants American consumers to borrow as much as possible on their credit cards for, to benefit the bank, but also obviously to boost the economy with borrowed money, with borrowed spending, even if it comes at a huge expense to the borrower. And so what I'm going to look at today is how this developed during the pandemic, because when you owe, and the balance we're talking about, the credit card balances we're talking about, is people that are actually paying interest on their credit cards. So people that have borrowed money on their credit cards, not those that are paying them off every month. And that balance overall of what people owe on the credit cards in the United States is now down over 10% from a year ago. And during the financial crisis, the same thing happened. Credit card balances plunged, but they plunged because borrowers defaulted on their credit cards. So they just walked away. They couldn't make the debt. They couldn't make the payments. They lost their jobs. And it's unsecured credit, so a bank can just try to sue you. But back then, the mortgage crisis was going on, and people didn't have any money to begin with. So there's really not a lot of sense in suing anybody. And if you don't get anything out of it, if people don't have any money, you can't collect anything. So credit card balances back then plunged over a 2-year period, or a little over 2 years, because largely people defaulted on their credit cards and walked away, filed for bankruptcy, and shut them. Now they're plunging, those balances are plunging for opposite reasons. And default rates, delinquency rates on credit cards over the last 2 quarters have dropped sharply. So people have gotten their stimulus money, they've gotten the extra unemployment benefits, they've gotten these other handouts from the government, and they have used this money not only to pay down their credit cards, but also to cure delinquencies that they had beforehand. So we now have fewer delinquent balances by quite a big margin than we had before the pandemic. We have 10% less in credit card balances outstanding, and now we get the latest data that actually a lot fewer people have applied to get new credit cards. So this whole money-producing, profit-producing enterprise of high-interest credit to American consumers is in a fairly steep slowdown, and the Fed is really worried about that. They're worried for the banks, and they're worried that the economy might not be stimulated by this sort of borrowing. But I think it's a great thing for consumers to pay down this high interest debt. And there are other reasons for that in the spending patterns. Consumption has shifted from services to goods. And a lot of the services that people used to spend money on, you can't really spend money on anymore. So restaurants are shut down. People don't fly as much anymore as they used to. They don't go overseas as much as they used to. The hotels and all, cruises, this whole thing has sort of disappeared from the spending pattern. And so now what people are spending money on are goods. But the amount of money spent on services, which has dropped a lot, is normally 75% of consumer spending. And now it's just plunged, and spending on goods has increased, but not enough. So overall, people are spending less, and consumer spending overall is now ticking down again, and it reflects, this whole combination reflects in the credit card balances. You have fewer people applying for credit cards, people using stimulus money to pay off credit cards that they were delinquent on. So delinquencies are coming down. You have people using the credit cards less because they don't buy services such as hotels and airplanes, etc., bookings anymore. And so we have a situation where the consumer actually looks pretty good in this economy, with 10 million people at least having lost their jobs still. And depending on what data set you look at, if you look at unemployment compensation, it's 20 million people. If you look at the household service, it's 10 million people that have lost their jobs. So different data sets, but we don't have that blow up of the credit card industry that we had during the financial crisis. We have the opposite. Delinquencies are way down, balances are down, the risks are down. And sure, there are people that cannot make the credit card payments, and then banks have the deferral programs. So when a customer has trouble making the credit card payment because it's a pandemic, the banks will negotiate with them and put the balance in the deferral program so they don't have to make the payment. So this is a form of extend and pretend, and which is creeping through every part of the credit field here in the United States. So we have this amazing image of in the middle of this pandemic with all these issues going on with consumers losing their jobs or actually the credit cards are in really good shape. And they're such good shape that the Fed's worried because consumers are not using the credit cards enough, obviously, to keep the economy propped up.
How ironic the government's worried that people are being fiscally responsible.
Yeah, I mean, in a consumer-based economy where, we are called consumers for a reason. That's our job. Our job is not to enjoy life. Our job is to consume and in this economy. And that's why we're called consumers. And so when we don't do our job very well, the economy goes into a tailspin. And our job is to consume the Federal Reserve gets really nervous when we try to save money and consume less, and it expressed that concern, in terms of the credit card balances. It said it showed the deep impact of the pandemic and because people aren't borrowing at 25% or 30%. To me, it's nuts to borrow at these interest rates. Consumers should just step away from that. And, but it's, it's not, some consumers are not doing it, but, we have no, laws against charging those kinds of interest rates in a zero interest rate environment. And I think hopefully, consumers are starting to look around and say, well, there are really better things to do with my money than paying 30% interest on loans, to a bank, that's if you owe $10,000 on a credit card, you pay 30%. That's $3,000 a year you're paying in interest. There's a lot of stuff you can buy with that money. So hopefully consumers are starting to rebel against those interest charges, and that's my hope, so that banks would have to become more competitive and offer better interest rates, lower interest rates. And they're doing that for really high quality credit risks that don't need to borrow on a credit card. So, if you have a stellar credit rating, you can probably get a credit card that charges 8% interest, but you don't need it. And somebody who really needs a credit card to buy groceries, they're paying 30%.
How are people dealing with their mortgages?
Yeah, so we have a what's called the K-shaped recovery in the housing market, or as one of my commenters says, the FU-shaped economy.
Why would somebody use that kind of a description for the economy?
Because there is a big part that's benefiting from the Federal Reserve's $3 trillion and the other central banks' QE programs, and from the low interest rates. So they're doing really well. The wealthy have done exceedingly well. Wealthy meaning the asset holders have done exceedingly well in this pandemic. They're all wealthier now than they used to be, and before the pandemic. That's from the billionaires on down to the smaller stockholders. And then there's a large portion of the population, 10 million to 20 million people, that lost their jobs and that don't hold assets, they hold homes, but they have all kinds of trouble now. And so that's the part where the FU takes place. Were the wealthy that did well and in the stock market and the assets that they hold, they say, well, FU, the rest of it, this economy is doing great for us. And so you have this kind of total split. And in the housing market, it shows up in the homes, in the mortgages that are insured by the FHA, the federal agency that insures the lower end of the housing market. So they're providing low down payment loans, essentially high risk loans to people with less stellar credit ratings. And the default rates are huge in these loans. They're now 17% in the delinquency rates. And these are mortgages that were delinquent before they were included in forbearance programs, and these are mortgages that are delinquent that are not included in forbearance programs. So these are just all the delinquent mortgages we have, and this is not a huge part of the housing market. You're talking, you're talking several million mortgages, but it's the lower end of it, and it is in terrible shape. And these people have trouble making the mortgage payments. They a lot of times have lost their jobs. They're also the people that are most exposed to COVID because of the jobs that they have, so the mortgages in this part of the housing market, they're in trouble. They're insured by the government. They're in forbearance programs. Everything is on hold. It's like this whole mortgage market has been put on ice. Obviously these people can sell the home, and because home prices have gone up, they could probably pay off the mortgage or much of it. If they all try to do that at once, you have the situation where prices will come down hard because a market cannot digest that kind of liquidation of mortgages. So that's where that FU economy expression comes from, the FU recovery, where one part is doing exceedingly well and says, well, go to heck. We don't really care about what happens at the lower end. We're doing great. Now, what recession? What pandemic? We're doing great. And you can see that in many things.
We'll have more with Wolf Richter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, can you explain to us the whole hullabaloo about the so-called container shortage and why farmers in North America are up in arms over it?
One of the fascinating things is that the shift by North American consumers, but also in Europe, from buying services to buying goods is how this has upended the transportation industry. And services don't have to be transported. You buy a plane ticket and you get on a flight, and that's a service. You don't have to put that in a container and ship it anywhere. And the same thing with haircuts and all the other services that we rent, all the other things that we spend our money on that are services. But goods have to be shipped. And so when consumers switch from buying services to buying goods, suddenly, and this happened over the summer and it continues. And so in the United States, durable goods have spiked during the pandemic to record highs. They're up 15% from a year ago. And whereas service spending has plunged. And all this stuff gets shipped in containers to the United States, much of it from Asia, but also from other parts of the world. And we see that record numbers of containers coming into the port of Los Angeles and all along the West Coast, all along the East Coast as well. And so these containers come over full, and there's huge demand in China for empty containers so that they can fulfill the orders and ship those goods to the United States. And so what would normally happen is a container carrier, that would be a ship owner, would bring those loaded containers to LA. They would be unloaded in LA, and then the empty containers would be placed in another area where it would be filled with exported goods that the United States sells. So that's a lot of that is agricultural goods. And that's, obviously the United States sells a lot of bulk agricultural goods that go by bulk carriers, so it doesn't go in containers. But the specialty products, smaller customers will order soybeans by container. All kinds of products that are shipped in container. That includes wine and fruit and vegetables and millions of other products. And normally these empty containers would be placed in those areas so that the farmers could fill the containers with the product and ship them out for export. That's not happening now. So now there's an investigation going on by the U.S. government in that it's alleging that container carriers are taking the empty containers straight back to China to have so that they can bring them back full with Chinese goods. And they're motivated by doing that because the shipping rates for shipping containers from China to the United States and to Europe too, they've gone up. They've more than doubled. They're up 160%. So ship owners can make a lot of money shipping containers from China to the United States, but the shipping rates from the U.S. to China have not gone up. They're very low. They're just a fraction of that. So it's really not worth for container carriers to wait for this empty container to cycle through the American landscape and get filled with some agricultural product so that it can be shipped back to Asia full and continue cycling. So you have this empty container waiting at the port for a ship to go out and go back empty. So that's one of the big allegations. That would be a violation of the law in the United States, where carriers, there's a common carrier law, and carriers would be required to negotiate with the shippers here. And that's what's being investigated. In addition, you have social distancing requirements that have slowed down the container ports. So unloading a container now takes longer, and so the backups, there are all kinds of containers in storage that are stuck, that are not flowing through the system, and that nobody was prepared for the sudden influx of imported goods into the United States, into Canada, into Europe. And so when the stuff is showing up, it upends the whole flow of the container industry. And there's already not enough containers out there because shipping companies who own the container or who lease them have underinvested in them. So now we have farmers complaining to Congress that they would love to export the goods, but they can't find containers to ship them. There's huge delays. And that includes the specialty products with refrigerated containers that are hung up in the system somewhere, so meat products and other things that go frozen or refrigerated over to other countries. And it's turned into a gigantic mess. And the shipping rates are such that it incentivizes carriers to not solve the mess. It incentivizes carriers to take whatever empty container they can find and take them back to Asia, and which just makes this whole thing worse. Now, this will eventually settle down, but and then I can see the effects of the surging goods out in the street. Yesterday I was walking home and there were like 6 delivery trucks lined up delivering packages to people along my street. And this is I live in San Francisco. These are multi-story buildings, but this is one after the other lined up. Post office, FedEx, UPS, the private delivery companies that are handling the Amazon deliveries. So there's a huge amount of goods and then all the stuff is imported. So all the stuff is coming in by container. And so this has just really made this whole industry chaotic. And containers need to flow. They need to constantly go through the system, and they shouldn't be going anywhere empty. And so this is it's like money. It needs to constantly flow. And when the flow is disrupted or when it becomes distorted, then you have the situation where on one hand there's a container shortage, on the other hand there are empty containers waiting to be shipped back or stuck in some place, and nobody can process them. So it's a real problem for the agricultural producers in North America to trying to export the product. And for the United States, that's a big export product, and it's not just cheap commodities product. You're talking about high dollar wines and all kinds of stuff, that now finds it difficult to get containers for export.
Wolf, a lot has changed in terms of what people are spending money on during the pandemic. How is that impacting the economy?
The biggest shift, and something I've never seen before, was the shift from services to goods. The lockdowns and the restrictions and the travel bans and all this stuff has led to consumers switching their spending over to goods. We have rent's a part of services. So we have eviction bans in place, so some people are not paying their rents. They can spend that money on other things. Some mortgages, a lot of mortgages 2.5 million mortgages are in the forbearance program, so these people don't have to make mortgage payments. They can spend that money on other things. And so now we have an economy that's much more spending takes place on the good side. So the entire transportation industry has been upended. We just covered the container part of it a minute ago, but what we now see also is in the trucking business. There's a boom going on in the trucking business. The railroads are busy. The entire last mile delivery scene has completely changed. Now the auto manufacturers, because there's so much demand for delivery vehicles, that auto manufacturers are now pushing really hard to develop special vehicles for that. I mean, they've always had vans, but now it's going to be electric vans because Amazon wants them, and many other delivery companies want them, and so there's a whole shift going on and it's being subsidized by the government indirectly through the stimulus payments. And so there's this whole shift going on towards making goods delivery more efficient in the United States, since it's such a big part of the economy now, suddenly. I mean, I now have to cut my own hair because I can't go to the barber anymore, and I bought some electric hair clippers a few months ago. Well, that's a piece of merchandise that's good to have to be shipped instead of paying for the service to go to the barber. Well, I got pretty good at cutting my own hair, and I like it. It's kind of fun to do, and it looks good, and so that service is not happening anymore in the future. I'm not going to use that service anymore, but I will replace the clippers when they break. And this is just a small example, but this has happened all over the place now, and so we're seeing the impact on the transportation industry all the way through from the railroads and trucking companies to the last mile and to the equipment providers, to the software providers for these companies that deliver. And I think there will be a revolution in delivery vans. I see a lot of that already happening. And they're manufactured in the United States, so that's a good thing for now. There's a huge push for delivery vans to be electric, and it's ideal because there is no range anxiety in urban delivery vans. They don't go very far. The big job is go from door to door, and they stop, and so they may only do 50 or 60 miles a day, and on the delivery routes. So the battery range is not an issue, but they're so much more efficient to do that. So that's now the big thing, and in a way that's really good. I'm looking forward to how this is going to pan out, because the old delivery vans, the old technologies, I always wondered why companies are still using them, and that is not changing. So that is radically changing, and I think it will have a big impact on the future. E-commerce has become such a huge thing now during the pandemic, as malls are dying, and so the delivery infrastructure, the fulfillment infrastructure for e-commerce is just going to play a key role in the economy.
Wolf, thank you so much for chatting with us, and best of the season.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter, and thank you for listening. We'd also like to thank our sponsors, American Manganese, Abin Resources, Engineer Gold Mines, and Golden Arrow Resources. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Best of the season, Larry.
Thank you, Jim, and the best of the season to you.
Larry, are there some Grinches patrolling around on the markets over the holiday season?
Well, I talked about a Santa Claus rally and a couple of weeks ago, and that I figured there was a bull market coming. And I see that starting to happen. It's definitely happening in the AMY situation. The stock has traded, yesterday about 16 million between the two exchanges. Closed up at 56 cents, and now it's trading at 50, but it hit a high of 71 on about another 14 million shares. And what does that tell you, and why did that happen? Well, I could see patterns in the way the stocks were trading, not just AMY, but, that they were strengthening, which told me that predators were actually starting to cover some of their shorts, and that was helping the market go up. But that said and done, there's now a release that's circulating from the OSC and IROC on looking for tips on abusive trading, which is predatory trading. And to me, that's the beginning of getting the predators out of the market. Most of these predators come from offshore, and they contribute nothing to the bottom line in Canada. They contribute nothing to the bottom line in North America. As all they do is rape and pillage and break companies and fill their pockets, and that is going to come to an end. Back in about 8 years ago, Dan McGrorty and myself published some papers, and they were picked up by some of the newspapers here in Canada about predator trading, and we called it, one of them was the Wild West. And that's what's been going on. I mean, it's like, there's no rules, there's nothing, everybody can do what they want when it comes to shorting stocks, and with no uptick rule. Now we're going to start to see a change in that. And what I like to see is that the Ontario Securities Commission is offering rewards up to $5 million if somebody can turn in a abusive predator trading short seller. And that's got to turn some people on. I mean, that's probably what's caused some of the recovery in some of the stocks, including AMY. And, I'm really happy to see some results coming. But to me, that's just a toe in the water. We've got to get that uptick rule back. We've dropped from 2,400 in 2011 to as low as 380 or whatever it was in this year. So, if that doesn't tell you a story that you can look up on the tape, nothing will. These guys are basically, eating the shareholders' lunch, as Eric Sprott would say. And this is exactly what's happening. These guys are enriching themselves and destroying the economy of the Canadian government by bashing these stocks down, not just in the junior space, but in the senior space as well. So I say 3 hurrahs for the steps that Save Canadian Mining have made so far. And they've at least got the attention of the Ontario Securities Commission and IROC, and they are starting to see that something has to be done. And so it's great days. We bounced up in 3 days from about 25 to 71 this morning, but now we're back at 50, and that's to be expected, though, under ordinary market conditions. The fact that the stocks run up so rapidly, there has to be a healthy correction, and then we can move again. So, Yeah, it makes me very happy. This is a crusade I've been on, and you've heard it on the podcast before, talking about predatory traders. You saw the pushback from the CEO and the bulletin boards, saying that I was crazy, but now it's out in the open. And, maybe I'm not crazy. And, I recognized the predatory trading back 8 years ago. And I've been talking about it and writing about it ever since. And now Save Canadian Mining, with their bankroll behind them, are able to do something. So this is a great thing for shareholders around the world that play in the venture market, and certainly a great benefit for companies like AMY that are coming out with fantastic news and backing by senators and Republicans in the U.S. and getting contracts with the Department of Defense and the Department of Energy, and yet we were still stuck in that 20-cent range. So I see that changing, and I couldn't be happier. Right now, of course, there's warrant exercises going on. There's new predators or same predators taking positions at higher prices by shorting stocks. And but I think that the message is out there that they're not always going to stand for this dissemination of companies. And when a lot of companies have lost their listings, a lot of companies haven't been able to do anything because they can't get financing. And, we were lucky to work very hard to get, about $11 million over the past 4.5 years, and to keep our product out in front and get patents on our process, and also, working with the U.S. government. We've also gotten grants from the Canadian government. So, yeah. You would think that would be spark plugs for a good market, but every time we put out a press release, which is you would think would be which would double the stock, and it goes up a few pennies, and then at the end of the day, it's down a few pennies, and people get fed up with that. I've known some good shareholders that have cashed in their positions at around 20, 22. And I guess they're probably a little unhappy today with seeing what the market has done, but, they read the bull boards and they start to believe them, and that's an unfortunate situation for shareholders. I mean, that's not the place to go to do due diligence. We maintain a website that is totally transparent. All of our accomplishments are on there. We've actually never had a step back except in the price of the shares, and yet you go to the bull boards and hear bashing the management and the company itself and our process to boot, and with absolutely no proof of any of that, and yet people get tired of seeing that it's not making the move, and they sell, and that's unfortunate because some of them really believed and really needed the money, and now they've cut off that opportunity by selling too soon. And this is what they do. I mean, they try to persuade the existing shareholders to sell so they can drive the company to nothing and make all the money. But anyway, that's old time talk, and I think that's what's going on right now. That my whole podcast should be dedicated to congratulating the Save Canadian Mining for the progress they made, and for this blip in this blip up in the stock that has actually created some millionaires, believe it or not. And so here we are, Jim, just going into the new year with a Santa Claus rally.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metal company that basically got its start with low-grade manganese in the U.S. We came up with a process that is patented to actually take low grades and turn them into commercial grades. So, that has been the start of the company. That's a cornerstone of our recycling opportunity. We've spent several millions of dollars developing that process, and we've been transparent every step of the way to keep our shareholders informed. And that's worked out very well for us. We're also looking at a spin-out of the mining assets, mostly gold, copper in BC, into a new spinco, which is in the works. And now we've got a contract with the Department of Logistics that allows us to actually test the stockpile, the critical stockpile, the strategic stockpile at Wendon. So we got a lot of things that we're doing. All of them will make news, and we expect to have positive results because of our patents. So we're also you can go to AmericanManganeseInc.com. Go through our site, and go through it, take a look at everything. Do you see any negativity there? It's because every time we announce results, we've had improvements, and you can see our process working its way through the whole system. You can go read our patents if you so wish, and so that's all on our site. And you can phone the company here at 778-574-4444. You can email LREAUGH@AMYMN.com.
Larry, have a great holiday, and we will be talking to you just before New Year's.
Okay, we'll looking forward to that, Jim, and you have a fantastic New Year, and all you people at Howe Street.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on December 23rd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HoweStreet.com. Company Showcase is a production of Howe Street Media Incorporated.